The objective of the ESRB is to address one of the most important weaknesses identified during the financial crisis, as highlighted by the De La Rosière report, the lack of an adequate pan-European monitoring, assessment and mitigation of systemic risks. In line with the ESRB recommendation to enhance macroprudential governance in each member state, in the case of Malta, it is the intention to replace the current standing committee by a joint committee on financial stability. This committee will include representatives from the Central Bank of Malta and the Malta Financial Services Authority, and would be mandated to monitor and assess risks to financial stability. Its objective is to formulate policy recommendations to the relevant boards of the two institutions, designed to safeguard financial stability, strengthen resilience of the financial system, and minimize systemic risk. The recently announced changes to the depositor compensation scheme are a welcome change and help increase the resilience of the domestic banking sector. They are also in line with the recommendations of the latest IMF report. Given the importance of addressing systemic risks in financial institutions, it is necessary for regulators to reduce, or if possible, eliminate the prospect that a systematically important financial institution would find itself in difficulties in the first place. This consideration also brings up the need of supervising better what is called shadow banking, which consists of those parts of the financial system that are not visible to regulators and hence not under their direct control and supervision. Basel III goes a significant way in narrowing the gaps in regulation that result from recourse to shadow banking. It does so by incorporating off-balance sheet exposures in the leverage ratio and by including in the liquidity, regulatory and supervisory standards a range of risks stemming from shadow banking. Thus, stronger banking regulation and supervision will go a long way towards containing the risks of the banking sector. I will now take a closer look at some key issues relating to the domestic economy and the financial system, particularly the fiscal situation, international competitiveness and financial stability. The outlook for the fiscal situation calls for continued vigilance and caution. Official projections of the deficit ratio for 2012 and 2013 have been revised downward, remaining below the Maastricht threshold of 3%. However, that forecasts have been generally revised moderately upward to levels projected above the 75% level in 2012 and 2013. During the last decade, Malta's fiscal deficit ratio followed a mostly downward path, as can be seen from this graph, from levels that exceeded the euro area in 2003 and in that period. The decline was interrupted in this chart in two periods, in 2003 and 2008, but these were specific instances when the government basically had to absorb some of the debt of certain enterprises. So the deficit ratio has fallen each year from the high of 4.6% in 2008. One also notes that since 2009, the deficit ratio for Malta has been below the average for the euro area and has been heavily influenced by the high, but however, the average for the euro area has been heavily influenced by the very high deficits in some member states, so like Spain, which is a very big country. Obviously, Greece went to deficit rates of 15% and above, 18%. And Ireland, a smaller country, went through this time through problems in their banking sector, went through deficit rates which were abnormally high, even up to 30%. On the other hand, the official forecasts for the debt ratio have been revised upwards, with the government debt ratio is expected to exceed 70%. So a strong case can be made for continued caution in Malta's fiscal policy and for further measures that would help to ensure the achievement of the government's targets. The recent IMF report for 2012 acknowledges that, and I quote, Malta has taken effective action to correct its excessive deficit, shoring up confidence in Malta's public finances. But it also recommends a return to a fiscal balance in the medium term. One has to keep in mind that low deficit and debt ratios leave more room for the application of counter-cyclical measures in the event of an economic slowdown without breaching the European rules. So the optimal way to reduce the ratio of the deficit to GDP is obviously through economic growth. In turn, faster growth calls for improvements in productivity. In this respect, there needs to be a greater degree of public awareness of the importance of productivity and competitiveness, and a consensus on steps that can be taken with minimal social implications or disruptions to enhance the country's international competitiveness. As you know, competitiveness depends on the relationship between changes in productivity and changes in costs, including wages. I have to note that unit labor costs, which are based on the relationship between compensation and productivity, have generally moved in line with those in the euro area. However, in recent quarters, Malta's unit labor costs have pulled ahead of those in the euro area, as shown in Chart 6. So I'm referring to this gap here. Of course, we suffered a lower downturn, and our unit labor costs still maintained that upward trend at a faster pace than in the euro area in 2009. Since then, they have tended to stabilize like the EU unit labor costs, but the gap here has maintained. So one has to be quite conscious of these changes. In this respect, the wage-setting process and efficient labor market practices are of critical importance. The fact that collective agreements in Malta are negotiated at the level of the individual firm helps to ensure that wage growth is compatible with the realities of the markets, where the firm sells its products. Still, further steps could be taken to improve productivity levels and increase the employment rate. Also, as I argued recently, COLA increases, so-called cost of living adjustments, should not be superimposed on wage increases agreed in collective agreements, but should form part of the negotiation process, so as to ensure that firms are able to match all wage increases with productivity increases. This is the only way to sustainability. Faster productivity growth depends on many factors, including investment, the infrastructure, the quality of the human resources, and hence the quality of the educational system and its ability to meet the skills requirements of a growing economy. Measures that increase the employment rate could include further policies that incentivize a higher female participation rate, as well as measures that facilitate more flexible work conditions, including part-time employment. A further requirement for economic growth is the smooth functioning of the financial system, particularly during these turbulent times. Continued economic growth depends also on the uninterrupted supply of credit by the financial sector to firms and households, and to that end, the stability of the financial system is essential. It is important to note that although its rate of growth has declined, bank credit has continued to increase in Malta, unlike the situation across the euro area. So this graph tries to highlight that if you take 2007 as a starting point, the growth in credit has slowed down, but has still remained positive, whilst in the euro area, as you can see, it has taken a bit of a dive downwards. So the recent IMF report that I mentioned earlier noted the strong performance of Malta's financial sector, but also stressed the importance of strengthening the resilience of the sector. The elevated levels of credit and concentration risks call for stronger financial buffers through higher provisioning and retention of profits. Such measures would strengthen the bank's ability to absorb potential shocks and would also allow them to prepare themselves for compliance with stricter Basel III regulatory requirements. On the positive side, the credit risk is being mitigated by prudent credit standards and cautious lending behavior on the part of the banks. On the funding side, the resilience displayed by the banking sector in the face of adverse international conditions is explained largely by the business model that has been a traditional characteristic of domestic banks, which rely strongly on retail deposits. Another indication of the overall prudent bias of the Maltese domestic banks is evident in the first chart presented earlier, which of course I will not repeat. But a further indication of the traditional funding model is this interesting chart that part of it I grabbed from the recent IMF meetings in Washington, and I superimposed the Maltese level in blue, in dark blue. This chart shows the loans as a percentage of deposits. And you can see that if you look at the euro area, the loans as a percentage of deposits was pretty high and still has remained high, although it has declined. In the US, United Kingdom, US, and Malta, it is lower, and in the case of Malta, it is one of the lowest, except for the last period, where the amount, the graph shows the US has even gone below what we have. This business model has served the domestic banking sector well. The traditional sources of funding have proven to be very stable, including at a time of heightened tensions in the international financial markets. While taking on the changes that are needed to remain competitive and improve efficiency, the domestic banking sector must also continue to build upon the strengths of the traditional model. Among the many lessons that may be drawn from the experience of the international financial crisis, one that stands out is the importance of each banking institution to keep a prudent mix of dependable sources of funding, to limit the level of financial leverage, and to maintain a sound balance sheet. In summary, I would like to conclude by stressing the need for further efforts to maintain international competitiveness and continued vigilance in the banking sector in the context of recurring uncertainty in international financial markets and in the world economy. With this in mind, one has to acknowledge that although the relative performance of the Maltese economy has been encouraging, the challenges ahead are to be treated seriously and with caution. A further lesson from recent experience is that fiscal prudence has to be a continuous endeavor, especially in the light of the recent upwards revisions in the public debt projections for 2012 and 2013. Further fiscal consolidation becomes more challenging in an environment of weak external demand. The choices that must be made between the various national priorities have to be compatible with the economic and fiscal limits, and these limits can become less constraining only through improved competitiveness and faster economic growth. Thank you for your attention.